Hello again, here is another video on corporation tax. It's again a small one, I hope. Now, the contributions account and its role in the company under German law. What we need to understand is the problem, so what it's all about, the information which we need to know to achieve our aims, how we get this information, and in the end, which balance sheet is relevant and for some formal aspects. So let's start at the beginning. If a contribution is paid back to the owner of a sole tradership, this would never be income because you have not become richer. You become back, you get back your money which you always owned at the beginning. So it's not income. And the same would be in case of a partnership. And now naturally the question is, will it be different in case of a company? And the answer, which we can guess already, is no. In case of a company and of a shareholder, exactly the same is true. So if the shareholder only gets back that money which he or she or a previous owner had paid into the company as a contribution at an earlier date, this is not income. The people involved don't get richer. So paying back contributions is not making someone richer. It's not income. It's just paying back a part of the costs of acquisition which you had for the shares. So in case where money is paid out to the shareholders by a company, we need naturally then to find out if it's a distribution of profits to the shareholder, then it's income for them. Or if it is a repayment of contributions to them, then it's just nothing, just a payback of cost of acquisitions. So what we need is exact information about which part of the equity of a company consists of capital paid in by the shareholders and which part of it consists of profits which were made by the company. So what are retained earnings? What we also need is a clear rule which part is used when. So we need a rule which allows us to decide to find out from which of these two parts, either paid in capital or earnings, a given payment was made. So to find out which part of the equity of the firm now goes back to contributions and which one goes back to or has its origin in profits is in principle is always a bad omen, is in principle very easy. For the total equity of a company, according to the tax balance sheet, there are only two possibilities possible because it's either contributions or it comes from earnings of former years or the current year. So you have only these two possibilities. And that makes life easy because at the first glance which we gain, it's clear that we only need to know the total equity and one of the two parts of it, then we can automatically calculate the third one. So if you have the total equity, and you always have that because if you set up the tax balance sheet on a given date, then you automatically have the total amount of equity according to the tax balance sheet. Now, what you need is then only the amount which is contributions or the amount which is earnings of former years and current year. One of both is sufficient. So if you have the contributions, for example, the earnings would be just the difference. So yeah, now the question is, which of the two components is better to follow up? The amount of earnings varies every year. It's a constant up and down because you always have profits and losses. So the earnings, new profits, contributions stay the same. Probably the earnings get more. Then you get some losses, the earnings get less. Then again, some profits, the earnings go up. So here you see the earnings, that's a constant up and down, whereas the contributions usually remain the same for a longer period of time. So it is probably far more easy and far less complicated to follow up the development of the contributions, so of the paid-in capital. And so that is what the German legislature decided to do. They just decided to oblige the firms to keep and update regularly a special account giving the total amount of their contributions. Yeah, so that contributions account is regulated in paragraph 27 KSDG, a rule which you don't need to know in details. And here again, you see something, namely, if you have the total amount of equity, then contributions and earnings can be kept apart, and the official share capital is always fixed in the statute, so that the contributions account only needs to show the additional paid-in capital. So let's say hidden capital contributions or other additional contributions which were made in excess of the official share capital. So to follow that contributions account up, that's all you need to have the situation clear. And that is what is done. So now the rule how the equity is used for dividend payments is a very simple one. First, all earnings are used up for dividend payments because one regards it as natural that earnings are distributed. Only when all the earnings are used up, then contributions can be used to finance a dividend payment to the shareholders. So that means you always begin spending the money from below. So if you have here our balance sheet and you see official share capital, contributions account, and earnings. Earnings is 5 million, contributions is 2 million, share capital is 3 million. Then a first dividend is paid. That leads to this development. 3 million leave the firm. The rest of the capital is still there, and the 3 million are taken from the earnings account because earnings are first used up completely. Then in the second year, we distribute 2.5 million dividend. 2 million are taken from the retained earnings. Then the rest of 0.5 has to be taken from the contributions account, and the rest is remaining as share capital and the new account is 1.5 million contributions left, and official share company capital is also left over. Last formulas, pacts are different depending on where the company is, and that is the most important part of that topic. And thanks and goodbye.